Welcome to the Market Huddle Plus, episode 43. I'm Patrick Ceresna with our weekly 30-minute catch-up interviews with past guests. This week, we welcome to the show Jesse Felder, the author of the Felder Report. Great to have you on the show, Jesse.
Hey, good to be with you. Thanks for having me.
All right. So listen, I want to dive right into it. You highlighted the bubble-like markets for months, but as always, bubbles often need a pinprick. And in this case, it came from Japan this week. What's your impression of the price action? And do you think that this was enough to start a bigger corrective cycle?
I do think so, but because I think it's not just the, potential unwind of the yen carry trade. I think there's a number of things going on. I saw somebody tweet on, that this kind of sell-off just came out of nowhere. And I think if you've been paying attention to, the developments in the markets over the last 6 months, then it's really hard to say it came from nowhere, right? We've seen the explosion of the dispersion trade, right? Which is, in some respects kind of a short vol trade. We've also seen the rebirth of the short vol trade, where you've seen, I think, just in the COT reports, we've seen money managers short, VIX futures to the greatest degree they've ever done. And then you have, the use of, the 0 day to expiry call options that is just off the charts, and massive inflows into leveraged ETFs. So I think there's just been a number of signs that the potential risk in the market has been elevated for a period of time. And it's not just the unwind of the yen carry trade, although that could be kind of the straw that breaks the camel's back, so to speak. But I think there are a number of things that are potentially unwinding from extremes that just went further than I ever thought they could go.
Well, yeah, it's exactly like if you think back to 2007, conditions were there, but it took those Bear Stearns subprime hedge funds to break and the Fed to start cutting in order to just put in a market top. And even in still October of 2007, it went and still retested the highs. But it was sort of like that turn point where everyone that was so enthusiastic about the market, suddenly it became toppy and distributive in its price action on that. So I wanted to talk a little bit about insider selling, because Nvidia's Jensen has been dumping shares for the last 4 months, and Buffett had quietly sold half of his Apple holdings. Insider selling is going full throttle. You wrote a piece on insider selling, giving smoke signals. Why don't you size up the current environment and how you see it?
Yeah, it's something that I paid attention to since the start of my career. I was fortunate enough to co-found a hedge fund back in the mid 90s. And it was really kind of our research was based around tracking insider trading activity. So legal insider trading, this is just mainly top managers at companies trading their own personal shares. And so it would be like watching Jensen Huang sell, $500 million of stock this year. Which is also a change in character from what he's done. In the past, he's exercised options and sold. The selling that he's done in the last few months has been just selling down his holdings for the first time. Really, we've ever seen him do that. And it's the largest size we've kind of ever seen. And I think, insiders there in aggregate have sold about $1 billion worth of stock. And that, to me, that's very interesting that happens in concert with a shift in the AI narrative from AI is going to revolutionize the world to, wait a second, maybe these companies don't have the killer app yet, the killer product that's going to, be the next iPhone or the next internet or something that's going to actually create the productivity and profits that people anticipate. But when you look at, when you look at insider activity in aggregate, and this is one of the most interesting ways to use it. Obviously, I think it's valuable on the individual kind of micro level, but on a macro level, you put it all together and you take all the selling among executives and compare it to all the buying. That sell to buy ratio over look back periods can be very valuable. And we saw that over a 13-week period during the second quarter go over 50, which is $50 for every dollar bought. And over the past 12 months, that recently went over 25 times, that 20-25 ratio, which is literally the second time in the past decade we've ever seen a sell to buy ratio that high. The other time was November of 2021. And what I think is not just interesting that it coincides with kind of that where we were in the market cycle back then. But insiders are especially good. Najat Sehun, who's the University of Michigan Business School professor, has really quantified this and demonstrated that insiders are really good at predicting economic activity and earnings about 12 to 24 months in the future. So if you just actually overlay that sell to buy ratio, invert it, and look at and advance it 12 to 24 months on earnings, S&P 500 earnings, it's a really good predictor of where earnings are going. And so I think right now, the massive sell to buy ratio suggests that we're headed for, just like it did in 2021, that we're headed for a disappointment in earnings over the next few quarters. And that would be a real surprise to Wall Street, which is expecting double-digit earnings growth next year.
Well, that's interesting because exactly to the point is that there was a Goldman report out there that was talking about these AI CapEx spending cycles being typically 4 to 6 quarters. And here we're in the 5th quarter of this CapEx cycle. And obviously the earnings, it's no longer enough for them to just be good earnings because the expectations are so high. It's not like these earnings were horrible that were just announced, but the expectations are of future growth is so elevated that you're getting this cycle where everyone's like, just isn't going to get too much better than this in this environment. Now, you specifically wrote a piece about the AI bubble reaching its tipping point. And you've been talking about this very expansion cycle. You did several pieces on it. Why don't you take us through how you saw this? Because you were talking about this months before we reached this kind of crescendo or this tipping point where we're finally seeing corrections. What was the writing on the wall in your mind?
Well, I think it's basically just kind of the same thing we see during every one of these cycles, which is you go through a hype cycle where the hype surrounding the new technology goes so far beyond what the reality could ever become. And so, the hype surrounding AI was going to create this huge productivity miracle. It was going to be super profitable, create these super profitable products for all these companies because it's going to drive demand for cloud and for all the services that Amazon and Microsoft and Google are providing. The reality is that there are some major problems with these large language models, and if you just listen to AI experts over the last 6 months, they'll tell you that the problem of hallucinations is really kind of intrinsic to the technology. It cannot be, addressed through using more data, more processing power, or anything. That you're always going to have these issues based on the way the technology works. And so that means, it's just not very useful to industries that rely on accuracy and security in these types of things. And you could also hear that over the last few months where you're listening to surveys of companies that were trying to implement AI, and they were all saying, we can't really find much use for it. Right, we're trying to get employees to use, ChatGPT or whatever, in their day-to-day operations. And actually, what employees were saying, something poll came out last week or the week before. Like the majority of employees were saying it actually is worsening their productivity, being forced to try and integrate these things into their workflow. That they're not really finding any ways to kind of make this work for them in terms of enhancing their productivity, making them more efficient. And so there's just been a ton of evidence out there that the reality is not going to live up to the hype. And so and I think that maybe perhaps the biggest point of that is that so many of the people promoting the AI hype, the generative AI hype, have suggested that generative AI and the current technology behind it are eventually going to lead to artificial general intelligence, which is computers thinking in ways similar to humans do, and in terms of problem solving, and perhaps even better than humans. But you listen to AI experts who are the people who are in the trenches, working on this stuff, including the head of AI at Meta, and said there's no way that the current technology is going to get us to AGI. It's just not possible. We're already reaching the limits of the current generative AI kind of iterations. And that's why we haven't seen GPT-5 come out yet. And OpenAI recently said, we're not even going to be able to release this thing in the fall during our big, thing, because we have not been able to come up, create the advances that we've anticipated. So there's just been a lot of evidence that the AI narrative is going to shift when it becomes more evident that the reality is not going to live up to the hype. And I think this is kind of one of the fundamentals that's going along with this yen carry trade, that people are starting to realize, wait a second, maybe, all of this investment is not going to pay off in the way that these companies have hoped. And we saw that in Alphabet's results. They did well on earnings, but free cash flow declined year over year more than 50%. And that's just a result of the massive capex going into AI. And so if that profitability of these companies, continues to deteriorate as cash flow suggesting it will, that's a problem. And I think that's what the markets are starting to reckon with.
When I hear you say that, what it reminds me a lot of is the 2000 bubble, in a sense that it was all based on the internet's going to change the world. It's going to change the way we do business, the way people access information, everything. And they weren't wrong. It did change the world. I mean, we're online right now on the internet doing this show. The thing is that it did change everything. And when people said, "Well, Amazon is going to be the leader, and they're going to own this market," well, they weren't wrong either. They did, but that was in 2000, and Amazon is the leader. 15 years later down the road, and at that time, Amazon still lost 90% of its value in the following bubble burst. They weren't wrong. Amazon became exactly what it was promised to be, but investors simply were pricing too much too quickly, anticipating this thing, and the bubble bursts, right?
Yeah, I mean, it's exactly. I think as they say, history rhymes, and that's literally how these cycles go. And I think if you read market history and you listen to people who've been around the technology industry for a long, long time, Fred Hickey's a friend of mine who's done a great job in this regard, that things always go in this, this type of a cycle where it's a hype-driven thing in the beginning. And then the hype doesn't quite live up to the reality, or it doesn't for quite a long time. And I think that's what, I mentioned Yann LeCun, who's, head of AI for Meta. He's pointed out that, we're at least a decade away from AGI, which is really the technology that would be kind of this game changing thing that would, be able to replace humans in a lot of different areas. If it's achievable. But the thing with AGI is that we haven't even begun to lay the foundations for what the technology would look like to get there, right? And all of these folks who are working on it will tell you generative AI, and I know this is confusing, GAI versus AGI, is not the technology to get us there. And so, but markets have priced a lot of these stocks as if generative AI is going to take us there, and it's just not going to happen. And so you're absolutely right, Patrick, to point out that when that hype meets reality and investors are disappointed, it eventually could work out. But between then and now, between now and then, you can see some significant repricings, and I think that's what we're seeing today is the beginning of those repricings to try and figure out, okay, what does a sustainable business model look like in generative AI, and how valuable is it? And that's the question that's going to be answered, I think, over the next few quarters.
Yeah, and the poster boy for this entire AI bubble has to be Nvidia. And you wrote a couple of articles on Gensanity and just like how crazy it got, like in terms of even just you could go through like the capitalization of Nvidia versus like European markets. It's just insane when you kind of look at how things got crazy that way. But what's your perspective specifically on Nvidia as a company?
Well, I think, I would come back to, I mentioned earlier, well, I think you brought it up that, Jensen himself has been selling in a way that he really hasn't done before. I think that's very telling. I think that's telling along the lines of, he understands that the current CapEx boom is not sustainable in terms of what the return on investment for all of that spending is going to be. That companies, all these companies are spending about $50 billion a year. I think
Yeah.
Microsoft, Alphabet, Meta, they're all spending massive, massive amounts. It adds up to the hundreds of billions of dollars over a couple of years' time. Markets have as Demoterin has pointed out, Nvidia at whatever it was, $70 or $80 a share when he did his analysis, was discounting not only that the company owns the AI market and its current market share and profitability indefinitely into the future, but that they find another market just as big and dominate it in the same fashion. And that is a lot to price into to a stock like that, because there's a question whether the current investment into the space is sustainable, and whether that they can maintain market share in the face of news that like Apple trained all of its AI on Google's TPUs. They didn't even use the GPU, Nvidia's GPUs. I think that was another part of this narrative shifting, where people realize, wait a second, if Apple can build their entire Apple Intelligence, infrastructure without GPUs, what does that say about Nvidia's hold over the market? So
Yeah.
I think, Nvidia, just look at it right now, trades 60 times trailing earnings. Yes, earnings growth is anticipated to grow rapidly. I think it's probably only 30 times or something, 40 times forward earnings. But if we see any hint that this CapEx boom is going to slow, that these companies are going to cut back, that's really bad news for Nvidia, right? I mean, if the stock's 60 times trailing earnings, and it turns out these are peak cycle earnings, I mean, semiconductors at the top of the cycle trade a lot of times historically have traded single digit PEs on top of the cycle earnings. Just because they are so cyclical, and all the other underlying businesses for semis right now are terrible, right? I mean, you look at just computer hardware, you look at smartphones, you look at autos, right, which is a big end market for semis. They're all super weak, and it's why we see Intel slashing jobs. They're also losing market share. But the semi market, the only thing that's kind of helped semis is this CapEx boom in building out data centers to support the AI, the drive to AI. And if that shows signs of waning at all, it's really bad news for a company that is built on multiples that anticipate the thing growing to the sky.
Well, I want to move on then, because clearly we're identifying that there's inherent risks in just continuing to play this one story. And you wrote a couple of pieces talking about it's time for defense to shine, and this is time to be contrarian and to view things. So the question then becomes, okay, so if this is where there's no longer any asymmetry in pressing this theme and this thing that's worked so well, how do investors now approach repositioning their portfolios? Like, what is it that one does in this environment where there is still some sort of alpha or some opportunity? How would you approach this?
Well, I don't encourage anyone to short sell. It's very, very difficult, as I personally can attest to. But I will say that it's probably we're at a point, I think, in the markets now, even after the decline that we've seen, and I have to say it's kind of flabbergasting to me to see the S&P 500 down less than 10%, and all the major media outlets talking about a crash. Right, this is not a crash. This is, I mean, yes, it's been quick.
Well, it was a Nikkei crash, but
right. But I mean, they're talking about crash in the S&P 500. I mean, you see it in the Washington Post, cover the business section today. And so when the major media outlets are calling a less than 10% correction in the S&P 500 crash, I think that, there's a little bit, sentiment's a little bit off base.
Yeah, and Powell's got to come and save the day, right? Like Powell's got to come in, these emergency cuts. It's down 8-9%.
That's on a 3% down day. Like what? those of us who traded through the great financial crisis and the 2000 2002 bear market and the 98, even the 1998 stock market decline, anybody who has kind of some perspective understands that this is not the type of this is not a crash in any respect. But I do think we are at a very interesting time, right? The S&P 500 is trading 21 times forward operating earnings, and with the Bloomberg Economic Surprise Index trading at its lowest level in 5-6 years. Typically, those valuations trend along with the economic data, and if it were to do so, it would require about a 15 forward multiple instead of 21, which could result in a pretty significant decline. I mean, more than we've seen, significantly more than we've seen. And so I think if there's that risk out there, and the risk of an unwind in a lot of these leveraged positions, I mentioned leveraged ETFs. You look at the Commitment of Traders report, and asset managers across the board are about as long as they've ever been. NASDAQ and S&P 500 futures. And that's representative, I think, of positioning in a bigger way. So I think there's potential for a bigger unwind. For me, that just means people should be as defensive as they're capable of being within their own system. I think, Buffett sets a good example here, right? I mean, he's, the largest single owner of T-bills right now, earning some, good money on cash, which not only, is generating good yield right now, but also gives him a great deal of optionality. Yeah. I think from, the other side of this is that I'm very, very bullish on commodities right now. I think Simon White put out a piece in Bloomberg, a week or two ago, pointing out that commodities typically sell off in the lead up to recession. They kind of go sideways around the start of recession. And then once recession has started, commodities rally. They do exactly the opposite of what investors believe they do, which is commodities need to get hammered in recession. No, they've already gotten hammered in the lead up. So if we are now, the SOM rules triggered, and we're all now entering a recession, we could be seeing a bottom in commodities right now. Money managers are, net short, a basket of 20 commodities in the COT right now. Yep. Sentiment is terrible in the commodity space. And what is Buffett doing? The only thing he's buying is Occidental Petroleum right now. You have Carlos Slim, another billionaire investor, who's buying PBF Energy and Talos Energy. And I really think the energy space looks interesting to me today, but the commodity space generally, I think if you believe we're in a longer term commodity super cycle, this is an opportunity today to take advantage to buy the dip in that space.
Now, when we're talking about commodities, clearly you're highlighting, Buffett using that cash to buy more Occidental. Like a lot of energy is the theme, and I get it. Energy is clearly one of the largest markets in the commodity space. It is the largest market in the commodity space, but thematically, there's a lot of other interest. Obviously, there's a lot of interest in copper, in the copper story. And we had when the copper was trading up along its highs, the guys like Stanley Druckenmiller were out talking about the story and how quickly the rug got pulled out of any investor that kind of bought that story. Uranium was like the hottest thing out there, and now you had like Cameco wipe $20 out in less than a month. You're getting some real blood on the streets on this. So when you're stepping back and you're talking gold, copper, uranium, energy, like, do you have some favorites in this space and ones that you're not necessarily hate, but simply is not where your focus is? Like, do you have some favorites?
Yeah, I mean, it's typically been for me precious metals and energy stocks for the last. I don't know. I've been really bullish energy since 2020, since the oil price turned negative. Yeah. That was a sign that
could be a bottom, be a bottom or minus.
Talk about blood in the streets, right? I mean that was about as bloody as it gets. And in the fall of 2020, I saw massive insider buying in the sector. The stocks have done really well, over that 4-year period, but they've pulled back here pretty significantly over the last 9 months or a year or something. And all these stocks a lot of them trade single-digit PEs, right? It's wild to me to see a lot of these really high-quality names trade single-digit PEs. Even as the oil price, people say, it's under 80, whatever, but we're still at the high end of the range over the past 10 years, right? Since the oil price crashed in 2014, we're at the high end of the range since 2014, and that's really good for oil company profits. The stocks are super cheap, and estimates for a lot of these companies are double-digit earnings growth next year.
Right.
So, to me, they represent kind of the opposite of the risk in the technology sector. They're also, when you look at their weight in the S&P 500, they're lower right now. The energy sector is lower today than it was back in the early 2000s, the bottom of the last major bull market for energy. So you could argue that they're cheaper today than they've almost ever been. And in an environment where we are massively investing in infrastructure, we're reshoring production, we're seeing demand, set new records, on a regular basis. At the same time as a lot of these companies are really kind of backing off on drilling new wells and things. I think that the supply and demand setup for energy, combined with the valuations on these things being very, very cheap, sets up an interesting opportunity for investors looking to be about as contrarian as you can in the market right now.
And you mentioned precious metals, and what's interesting. Obviously, there's a big debate in the group as to whether this is about owning physical gold and silver, or at least trading gold and silver directly. And there was a whole camp of investors out there. How could you ever own gold miners? Because over the last 20 years, they've done absolutely nothing, and gold has gone 5x in that same time frame. Do you think there's a contrarian opportunity in the miners, or are you more interested in the commodity itself?
Well, I love that actually the mining stocks have done really well over the last year or so, and still nobody wants to own them. I mean,
no one gives a
one
shit.
that I've owned, the major focus of my portfolios, Agnico, Eagle. It's such a high quality producer. Their cost, production is just over $1,000 an ounce. And, we're sitting here at $2,400 gold or $2,500 gold or something. And so they're printing money right now. And it's just high quality operator, mainly in Canada, and, very, very low cost of production. And so that stock's done really well. So it's surprising to me to hear people say, I don't want to own these things, even though they've done well, which is kind of what we've seen with precious metals generally until very recently over the last year. I mean, we've seen year and a half, maybe, stocks, the gold price really turn around and start to take off over the last year. And ETF investors for a long time were still just dumping stock. It was really, just central banks and individuals overseas had any interest at all. To me, that was a very bullish contrarian sign that prices were going up and still people were dumping their gold holdings. Now we're starting to see a turn in ETFs, where we're starting to see some inflows into gold ETFs. And I think this aligns with the monetary cycle, right? We're getting close to rate cuts. People starting to realize, gold does well when Fed starts cutting. And so they have to have a position. So these major moves in precious metals are typically driven by Western investors pouring into the ETFs. And so I think if we are near that, the timing of the monetary cycle, along with renewed interest among retail investors, makes me very, very bullish about, the prospects for the metals themselves, over the next few months or so. But the fact that nobody wants to still own the miners, and I look at a couple different measures for that. I just look at the relative performance of the miners versus the metal. And you can see when you get big spikes in that ratio and the miners outperform, it's typically a good sign that sentiment has gotten ahead of itself. We're nowhere near that. And so that tells me that probably the cycle has some room to run, that we're likely to see investors start chasing the miners again before this move to the upside is over.
All right, Jesse, we're running low on time, but I really needed to touch on one last subject with you. And I wanted to talk about like credit spreads and yield curves, because we obviously had a spike in in the twos tens. We're almost back to zero, and obviously as you get a particularly bull steepening, it obviously is often associated with recessions and downturn cycles. Like I'd love to get your feedback on what you're thinking there, but also credit spreads just on high yield. They were at like 300 basis points, like low 5-year lows in this kind of environment, late stage environment. And obviously in the last week, we got a proper spike. The first time we saw those credit spreads start to widen again there. What's your thoughts on how the yields markets are kind of emerging here?
Yeah, the action in spreads is really interesting to me. That's one of the things that I track. I try and track what I call my risk appetite index to see are investors moving towards risk on, they move in risk off. And so spreads are one of those components. I want to see the trend in the VIX. I want to see, high beta versus low volatility. And I want to see basically the bid-ask spreads in, SPY and QQQ. And you can kind of look at all these things and just kind of see how are they trending. And when they're trending, positively, people are looking for high beta, people, spreads are real narrow. That's a sign that investors are risk on and usually don't want to kind of step in front of that on the short side or even being defensive. But part of the reason why I wrote that perhaps it's time for the defense to shine over the last few weeks is that I was starting to see a shift in risk appetites where people were shunning high beta in favor of low volatility. We're starting to see those bid-ask spreads in the major ETFs widen. We're starting to see corporate spreads widen. And to me, that's a sign that points towards a greater risk-off move that really is typically what you see during times of weakness in stock prices. And so I think in order to see a sustainable rally in the stock market, you'd want to see all those things kind of really start to improve in a material way. So to me, the spreads are important, but they're even more important in the context of all these other risk appetite indicators, which are suggesting we could be seeing a major shift away from risk on to risk off on the part of investors.
Well, there you go. Well, Jesse, thank you so much. But before I let you go, for those of our listeners that want to follow you, know more about you, what you do, and what you offer, why don't you let them know how and where they can find you?
Yeah, I'm active on X, formerly Twitter. Handles just @Jesse Felder, and I tweet a lot of this stuff that I've been talking about, the insider stuff. I tweet, I've been tweeting a lot about AI recently, just kind of tracking that narrative to see our investors paying attention to how the narrative around AI is shifting. But also write a weekly blog post at thefelderreport.com. I send that out as a weekly free email. You can just sign up for right on the homepage of the website.
Oh, fantastic. Well, Jesse, thank you so much for giving us your time. I love your insights, and I appreciate you taking the time to spend with us.
This was fun, Patrick. Thanks for having me.
All right. Thanks. All right. So thank you for tuning into the Market Huddle Plus. We'll be back next week with another episode. Cheers, everyone.